What a difference a year can make. So can we see a show of hands for how many people were here last year again? So a pretty good amount. It was much different sentiment, much different feeling last year at this time. It was, we were here on February 11th. It was the bottom of the market for 2016, and it was a much different feeling out there. And so typically with this presentation, we always like to look ahead and look forward and be proactive, not reactive. But there was a lot of good lessons to be learned from last year, a year like 2016, that we want to look at and go over. So at this time last year, we had just gotten done with 2015. Probably had the most volatility that we had seen since the markets bottomed out back in March of 2009. For the first time in over 4 years, we had a market correction as well. The S&P was down about 11.5% when we gave this presentation on February 11th. The NASDAQ was down 15%. Those are two major asset classes that we invest in. So as you could tell and probably saw, our portfolios were down with these indices. There's a lot of fears of a global recession. And we talked about it a little bit. We felt there was little chance of a Trump presidency. So we'll kind of talk about all these, how that has changed. So what they were saying, I pulled some of the quotes that we used in last year's presentation. And when I say they, it's the media, market commentators. We always talk bad news sells better than good news. Economic outlook, China's slowing growth likely to set the tone. Why the stock market is obsessed with oil. Federal Reserve's foolishness continues to fester. Three major themes being driven by this global recession fear was oil, China, and the Federal Reserve and what they were going to do. So general sentiment at the time, China. Their economy was collapsing, would bring the world economy down with them. They had gone from about 13-12% GDP growth early in the 2000s. Last year was probably closer to 6-7%. The feeling was their slowing growth is going to hurt the world economy. Oil. The U.S. oil industry was on the verge of bringing down the U.S. economy. It was a major headwind we were going into, and a lot of people felt this was going to really bring down the markets and the economy. And the Federal Reserve. The stock market couldn't survive without quantitative easing and would be doomed in a rising interest rate environment. They said, with all the monetary policy helping the stock market, what would happen if they raised interest rates 4 times in 2016? There were real concerns in the stock market. And what we were saying, the theme last year was view the present with clarity. So what did that mean? We were talking, recession factors really weren't in place and still aren't in place. Nothing was fundamentally wrong with the U.S. economy. There was a lot of noise out there, but there wasn't anything looking at the economy and the fundamentals to lead us to believe that we were heading to a recession. Labor market was strengthening. The biggest thing was finally we saw rising wages. That was what was missing through these past 7 years, and once we saw wages on the rise, that gave us a lot of hope of continued economic growth. The U.S. economy was not dependent on China. We talked about, really, our GDP is made up of less than 1% of purchasing from China. Oil impact was going to be regional. Texas, the Dakotas was going to have an impact, and it was going to be a headwind for us. But less than 2% of our GDP growth was driven by the U.S. energy market. We also talked about oil not being correlated with stocks. And rising interest rates would actually be a positive. If the Federal Reserve was raising interest rates, it meant the economy was improving. So our advice, stay disciplined. So what happened since? Stock market rebounded, was up 23% since that point last year. Financials and technology led the way. China really had minimal impact on the markets. Emerging markets actually were up just about 11% for the year. Oil stabilized, went from under $30 a barrel. Now it's kind of stabilized to low 50s. Interest rates rose more than 1% to close out the year. We saw it didn't affect the stock market. Stock market was up along with it. Brexit came and went. Could have been a real, a lot of people were really fearful for what was going to happen with Brexit. It came. We saw some volatility for a week or two. We moved on. And Trump won the presidency. So, again, we'll get more into that later, but some things we can go through. So lessons from 2016. Like you said, block out the noise. That negative sentiment from the media, from market commentators. Fear sells. Not all, they may be right in some areas, but I think last year was more fear than what was actually happening in the markets. Be a disciplined investor. If you look back to see what happened in the first half of the year and what sectors drove the growth of the market, That totally flipped for the second half of the year. So if we were invested in technology, we're invested in financials that didn't do so well early on, if we said, you know, let's give up on these investments, let's go to some of the better performing sectors, those sectors totally flipped. The better performing early on was telecom, utilities. They performed down mid-teens to low 20% in the second half of the year. So continue to be disciplined. Think with our heads, not with our heart. You know, it would have been really easy to sell off in February after a year like 2015 and after a start like we saw in 2016. And never try to time the markets. You could have easily have gone out of the markets with Brexit. You could have easily have made big decisions with the elections, and those things would have really hurt you as an investor. So we always talk about not trying to time the markets. We can be tactical and make some moves, but we don't want to go all into stocks, all into bonds, all into cash. That'll never help us. And our key takeaway is 2016 was a great year to look at your tolerance for risk. You know, we had the early on how the markets did, how the portfolios did. If that volatility was too much for you, or you were really uneasy with what was going on, it may be a good time to just kind of take a look at, all right, what's my tolerance for risk, and do we change that with the portfolio? Again, we go back to this. You know, it would have been really easy last year too. And this average investor, really what it tracks is inflows and outflows from mutual funds. So what it shows you is when markets are up, a lot of people are putting money into equity mutual funds. When markets are down, they're taking money out. And it's the exact opposite of what we should be doing. So like I said, last February, it would have been really easy to take money out of the stock market and put it into bonds, put it into something that was safer. You know, the difference between the Barclays US aggregate, which tracks the US bond market, versus the S&P from February 11th to the end of the year was a 25% swing. So if you took a portion of your portfolio and said, stocks aren't right for me, I'm going to go into just bonds, it could have had a really tough impact on your overall portfolio if it really wasn't fitting in with what your risk was. So 2017, what's our outlook? I'm going to take just kind of a high-level approach to what we're seeing in the markets, what we're seeing in the economy. Frank and Marty will get into a little bit more detail on what we're doing in stocks and our fixed income side of the portfolio, but I want to talk a little bit about what our outlook is. So we've been talking a lot about the Federal Reserve and quantitative easing going a few years back and low interest rates. That was really driving monetary policy. With the new presidential administration and President Trump, we're going to see some fiscal policies come into play, deregulation, lower taxes, infrastructure spending. How is that going to impact both the economy and the markets? So 2017, we're looking at 17 as a year in transition. And what does that mean? So from an economic and market environment, we're seeing, again, we talked about that monetary easing and the Federal Reserve. Well, we're going to see some, probably from everything that we're hearing, some fiscal stimulus. Globalization, if you listened to Trump's speech last night, a lot of it was America first, this nationalization type feeling, nationalism feeling. So how is that going to impact the economy? We went from a disinflation to an inflationary probably environment going forward, especially if we pick up the spending. And we're going from, you know, some areas that we thought were maybe safer to maybe some volatility. And we haven't seen it so far this year, but it doesn't mean we're not going to see it as the year plays out. Your investment goals and preferences. So we always talk about this. I think this goes back a few more years than just the transition into 17. But you talk about yield, especially for retirees. What's the yield? What are we going to get from a fixed income or even equity yields? Well, we really want to look at your portfolio from a total return perspective, and that's driving a lot of our portfolio decisions. Perceived safety. Some asset classes that we thought maybe were safer, you talk about bonds in a rising interest rate environment. They may not be as safe as they once were. So we're seeing more risks in the market. So we're gonna manage the portfolios to help mitigate some of that risk. And again, that low volatility to increase volatility. Investment implications. So we're a little overweight stocks, and we're going to talk about that later. And there's a reason for that with a changing interest rate environment. We may be moving from large cap to more mid cap, small cap stocks. And you've probably already seen that, and you may continue to see that as the year plays out. Growth-oriented funds to maybe more value-oriented investments. In defensive sectors to more cyclical sectors, technology, financials, consumer discretionary. Those are all cyclical sectors that we're investing in. Economic outlook and portfolio positioning. So 3 major economic outlook themes. The labor market and rising wages supports economic growth. What does that mean for the portfolio? overweight technologies, overweight financials. We have consumer-oriented names with a focus on U.S. regional banks with increased interest rates in the housing industry based on where we're at. Our new home builds right now are about 2/3 of what they should be with the growing population. We have low supply in existing homes, so we feel home building could be some value there. Interest rates and inflation expectations may rise above current levels. So our portfolio positioning with that is we're a little underweight fixed income relative to our equities, but we're focusing on higher credit quality bonds and lower duration bonds. And Frank will get into that a little bit as the presentation goes on. And the US dollar strengthens subject to higher rates and trade policies. So we have increased exposure to small and mid-cap stocks while overweight US stocks relative to both developed and emerging markets. Trump presidency. So a lot of people watched the speech last night. It actually was pretty good. I mean, all things considered, and I think the stock market reacted likewise today. So what are we seeing with the Trump presidency? Lower corporate tax rates. This should have a positive impact on earnings. Revamp of individual tax code and lower income tax rates. Positive impact on consumer spending. We're going into that home builders, technology. Those should all be helped by the consumer. Deregulation of financial industry and deregulation in general. One of my favorite things he said last night was for every new regulation, we have to take 2 off. That's great. I mean, that's awesome. I love hearing that. Should be good for business, small businesses. Increased fiscal spending, focused on improving aging infrastructure. Again, should be a positive near term, potentially negative long term, but at this point in the economic cycle and market cycle, we're looking long term that there could be volatility. So we're already focused on that. And increased tariffs and goods made outside of the US, negative impact on multinationals, positive to small and mid-cap companies here in the US. So those are a lot of the themes that we're looking at and how we're investing the portfolio right now.